So for nearly 2 years now, I've been sharing with you these updates every 6 weeks on what's happened with the Bank of England base rate. And for the majority of those videos that I've done, the rate has increased. We went from that 0.1% in December 2021, which in itself was an incredibly low rate that we got to after drops from the pandemic. From that 0.1%, after successive increase, we got to that rate of 5.25%. That wasn't until 6 weeks ago, the last time one of these meetings took place by the Bank of England, where they decided to do nothing and keep it where it was. Well, we've now got the November decision has been released and it's staying at 5.25% again. So, obviously, if you're a homeowner, these increases weren't exciting. But in terms of telling you what was going on, what was videos, it was, it's going up again, it's going up, will it, won't it? Well, we've had another pause, another kind of like settling down. And I will take you through in this video what that might mean for your savings and for your mortgages. But I'll also talk about what it might mean for inflation, how much prices are going up, and for the base rate, which obviously has a big impact on savings and borrowings, not just for the rest of this year, but also into next year and the year beyond that, because the Bank of England have released also in there an additional report where they see things hopefully going. So I'll take you through exactly what that means. Let's focus first of all about this particular decision, how it came about. Now, those of you who watch these updates that I do every 6 weeks, when the Monetary Policy Committee from the Bank of England meet, you'll know that there are 9 people on this committee. And effectively, it's the majority that wins. The decision is based on the most people who vote in favour of it. So last time, that decision to pause the rate at 5.25% was 5 in favour of that and 4 who wanted an increase. So a really, really tight margin. This time, it's still tight, but it's gone to 6 people wanting the pause and 3 people wanted an increase. So, there's that movement more towards, less people being aggressive and pushing for another hike. More people going, let's stick where it is for now, at least. And I'll come back to what that means for now, whether, when it go up, could it go down in the future? Why they did this? Why the majority decided to keep it as it was? So we all know, anywhere we go, anywhere we spend money, prices have been going up. And this is measured in inflation. It's based on what the prices were a year ago. And so let's say something was £1 a year ago. It now costs, let's say, for example, £1.10. Then inflation would be 10%. That's for an individual item. The individual inflation rate we get is a basket of goods, they call it, but it's all sorts of things in there, and you get this kind of average figure. And there are other different rates of inflation as well within that, but we'll just focus on the announced rate of inflation that's used most of the time. Now, that inflation rate, and it's always done a month after. So the figure that was released a few weeks ago in October was for September, because obviously you need to know what happened in that previous month to look back a year ago. So the most recent figure we have for inflation is 6.7%. 6.7. Now, this is way down on that kind of 10, 11% that we had, not too long ago, but it's also a long way off that 2% target that the Bank of England wants inflation to be at. And it stayed the same 1 month on. So August 6.7 and September was 6.7%. So no real change. But the Bank of England decided, or the majority of people decided that, it's not got worse. And they've looked at some forecasts, which I'll come back to in a minute, and they see hopefully where it's going. And on that basis, their thinking is that maybe we've increased interest rates enough. And the reason why they're linked together, inflation and interest rates, is because the theory, the economic theory at least behind it, is that if you increase interest rates, the base rate of interest, it forces some people to cut back and spend less money because they can't afford, their mortgage payment's gone up or whatever other things are something more expensive. They can't afford stuff, so they spend less money. Or you've got people who go, it's quite attractive to save money now. I'll put money away rather than spend it. And that means less money comes into the economy. And that means businesses who are there are like, we need money. So we have to lower prices in order to get people in to spend. And obviously lower prices will mean inflation starts to drop. And I know most of you know this, but it's always worth reminding you that when inflation falls, it doesn't mean prices go down. It just means that they rise at a slower pace than they were before. For prices to actually go down, you need deflation, and no one's looking at that. Whereas prices will continue to go up, but not at such a high rate. But anyway, so the Bank of England are going, right, we've done all of these 14, 15 meetings where the rates have gone up, all the way from 0.1% to 5.25%. We're starting to see inflation coming down. We think it's going to go down further, hence a pause. Because the danger of another increase, which, again, some of them think they need another increase, to kind of accelerate this and push this, the danger is, well, people really don't spend any money, and then you push an already fragile economy into recession. Or you also, make the pain that homeowners who are coming to remortgage or on a variable rate mortgage are having right now even more severe. They're even more difficult for them to actually afford their payments. So there's pressure not to go too crazy on things. So there we are. We're on this pause. Now, as I said, a lot of that is also based not just on what's happened with inflation this month, but also where they see it going. And they've kind of outlined from research that they've done what the market thinks will happen for inflation. They think that next month's figures, October's figures that will be released in November. Okay, so the next figures we get in a week and a half, 2 weeks, they think inflation will drop by quite a bit to 4.8%. And then by the end of this year, it'll be down to 4.5% for the end of 2023. So those will probably be the figures that we get in January based on December's 2023 versus December 2022. I know it all gets a bit fiddly, doesn't it? But down to 4.5%. And then in a year's time, by the end of 2024, around 3%. And then hopefully by the end of 2025, so in 2 years' time, 2.5 years' time, hitting that target of 2%. So they see that as what they've done. If this is what happens, they're happy with that. They want that 2% target. Might take 2 years to get there, 2.5 years to get there. But that means that hopefully we've done enough to bring that down. What that doesn't mean is that rates, because that's where we're going, that interest rates themselves will start to fall down. Because the bank is saying that rates will need to stay at roughly this level for a while now in order to get inflation down to 2% for 2025. And what they're saying, the market prediction is that they will stay around that 5.25% for another year. So potentially this time next year, we'll stay at 5.25%. And then gradual decline, not a sudden decline, a gradual decline that by the end of 2026, so 3 years' time, we could be around 4.25% for the base rate. Now, this is all looking ahead. This is all predictions based on all sorts of things that are going on. And as you know, if you've watched my video updates on this for the last 2 years, a lot has happened in that time that has thrown one prediction completely out the water. And next time we're saying it's going to be this, it's going to be that, it's going to be this, it's going to go all over the shop, right? But this is just the current thinking. And all we can do is work on that current thinking. But of course, it does mean that if something does happen, if inflation doesn't go to, 4.8% for the October figures, 4.5% by the end of the year. If these things don't happen and it stays where it is, it becomes sticky, or even worse, goes up, then, that committee might go, we need to push it up again. Maybe we'll go. Just, a few months ago, we're looking at a 5.5, 5.75, maybe even a 6% peak for the interest rate. So current thinking, potentially we have peaked and potentially we'll stay there for a year. And then we'll stay not too far beyond that as we go on for the year, 2 years, 3 years after that. So very, very long-term forecast, but it's all interesting when it comes into how this affects your savings and your mortgage. Let's talk about savings first of all. Now, 6 weeks ago when I did one of these updates, we'd already started to see some decline in the rates available for fixed rate bonds, fixed rate savings, where you go put your money away for 1 year, 2 years, 3 years, 4 years, 5 years, whatever it might be. And that was because we'd already seen some very, very high predictions of where the rate could go, which have been factored in, downgraded. So we go, if it's not going to go that high, then our rates can come down a little bit. And they started to fall until that NSNI bond came along paying 6.2% for 1 year. And that kind of propped things up, not just on 1 year fixes, but other fixes, kind of kept them at a certain level. Well, sadly, that went about a month ago now, in early October. And since then, because over on bigcleveryourcash.com/savings, I'm sure you know, myself and the team, we're updating the savings pages every single day. We have seen those fixes dropping again, slight little increments. Maybe one provider will come in, it's a little bit higher. They want to be at the top of the table. They want to get your money in. So they've got that money there and they can use it for whatever they want to use it for. And then it disappears. But broadly, the providers dropping down. And although at the time we're recording this, you can get 6.03% on a 1 year fix, below that, 5.95, 5.9, 5.85, 5.8%. We're talking about one or two providers really giving you above that kind of 5.85 rating. And then obviously much, much more below that. And I think potentially we could see that continuing if we're thinking we're not going to get any higher. In a year's time, 2 years, we're not going to be any more. Similarly, 2 years, 3 years, 4 years, 5 years, you can't get above 6% there now. And I wouldn't be surprised, can't guarantee it, but I wouldn't be surprised if we start to see those coming down. And in fact, when you look at this even longer ones, those 3, 4 and 5 year fixes, it's really just one or two providers with these higher rates, and then a big drop down to the next ones. So there's always a risk in this that the next meeting rates go up, or the one after that they go up, and you've locked in a rate which isn't the best possible rate out there, but they're still pretty high, and they're not as high as they were a month ago, 2 months ago, 3 months ago. So if you haven't already, and you do have money you are happy to lock away, because remember, when you put it in a fix, you can't get it. I said this last time, 6 weeks ago. I said it time before that, 12 weeks ago. Really, I wouldn't hang around. If you're waiting for rates to go up, I wouldn't do that. I might be wrong, okay? So you've got to make that decision yourself. One way around it, of course, is to put some money in a 1 year fix, some money in a 2 year fix, some money in a 3 year fix, and spread that kind of load out. So let's say in a year's time, that 1 year fix expires and rates have gone up. Well, that money can be reinvested into another fix. But if it's gone down, but you've also locked in for 2 and 3 years and other money, well, they should protect some of the money at a higher rate, and you just lose a little bit on the 1 year. What might be slightly different is easy access rates. And we have seen now for a couple of accounts paying 5.2% easy access, which is great. A few more below that, you can easily get above 5% on your easy access savings now. And that, I think, if we're looking at the base rate staying at this level for a year, there's not really any reason for that to change. They might pull the accounts for new customers, but I'd imagine if you're an existing customer in one of those accounts, you'll be okay. Whether we see many other providers increase their rates to catch up, I don't know. We've seen a lot less of that recently. Could still happen. And obviously, I'll let you know in my monthly savings account updates here on the channel and over at becloveryourcash.com/savings when or if they happen. But broadly speaking, you can look at those easy access accounts. That's pretty decent. You can access your money whenever you want. Not too far off what you're going to get in the other fixes. But again, it could change. It could well change. These are variable rates. They can change at any time. Only fixes that can't move around. What we haven't seen at all, and maybe we won't see now, is much action as well on those really super high incentive accounts. I thought maybe we'd see some of those regular savers that come with current accounts go up, but they've roughly been, some of them now, 5.25%. Well, why put it in a regular saver, a variable regular saver, the rate can go down when you could put a similar amount in an easy access? Yes, we can get 7% with First Direct, 8% with Nationwide, but not too much elsewhere. That's savings. Let's talk about borrowing and mortgages here. Obviously, general borrowing, as I always say with this, the high rate is still a high rate, right? This is still 5.25%, is still the highest it's been since, 2008? So that means that is going to have a knock-on effect for any money you borrow. So obviously, with credit cards, as I always suggest you guys, the best way to use them, and I use them all the time, is when you pay them off in full every single month. You completely clear the balance so you don't get charged any interest. So from that point of view, if you're doing that, you're earning cash back or rewards, whatever it might be, you're not going to be impacted. But obviously, if you are someone who has debt on them, those rates could well increase. Or if you're looking for those 0% deals, they have all got shorter over this period. You might find it harder to get one with a long period to reduce that length of debt. So again, it's worth just checking what your current situation is. But absolutely, if you are paying interest on your credit card right now, please do try and get it on a 0% deal to help you clear that debt faster and reduce those payments. Where it's probably going to be more pressing for people, as it always has been since December 2021 when these increases started, is for mortgages and homeowners. And the pause is good news there. You aren't going to suddenly see your rates go up. But they're still, again, as I said, really, really high. And those who are going to come off a fixed deal, more people all the time come off these fixes. If we're looking at another year of rates being around this level, and then a couple more years after that, not too far below that, it kind of means that this is not. We know for ages now we're not going back to those super cheap mortgages. That's not happening, if ever, but certainly not in the next few years. So you really have to make sure you are budgeting when you come to remortgage or buy your home for the first time. You've really got to budget on those payments being that high. And it's really, really, really difficult, obviously. If your mortgage is coming to an end, don't forget you can lock in often 6 months in advance onto a new deal. So if you are worried about what might happen in 6 months' time, in case rates did go up, you could lock in now on a deal. Do check there aren't any penalties for exiting it. But as long as there aren't any penalties, then if rates have gone down, either the base rate or mortgage rates, obviously, often follow them very closely, although it's not exclusively, very closely, then you can maybe ditch it and get a cheaper deal later on. Certainly wouldn't be leaving it to 6 months later to see what happens. If you're someone who has been waiting on a variable deal because you're hoping rates will come back down after a fix already ended, again, probably not realistic. But what I would say, again, I am not a mortgage expert. There are lots of them out there. Talk to mortgage advisors, get their sense of what's available in the market, get their sense of how long to fix for. You know, it's interesting that still that a 5-year fix is cheaper than a 2-year fix. That's still the case, as it was 6 weeks ago. And we've seen, used to be the other way around. But, you know, it gives you that certainty, but you are tied in for longer. You can even fix in for longer beyond that as well. But talking to a mortgage advisor, it's probably one of the best things to do. I will do another one of these updates in 6 weeks' time, a nice Christmas episode where, let's see, will it stay the same? Will inflation have dropped enough for them to say we're doing the right thing? Or will we've got a bit sticky? Will it have gone up potentially? And will that force another increase? I'll obviously let you know as soon as I can as the decision is made. My name is Andy Webb. Thank you so much for watching. Check out these videos right here for more ways to boost your savings.